Hi everyone. One of the most challenging topics you're going to cover this semester is balance day adjustments. So I figured I would prepare a recording and hopefully you'll be able to watch this as many times as you need. And it's just a verbal summary of chapter 15 of the prescribed book. So before we get started on balance day adjustments, we need to do a quick recap of cash versus accrual accounting, because it's only in accrual accounting that you're going to have to worry about recording these balance day adjustments. Let's jump right in. So we'll head over to cash versus accrual accounting. Right, so on the left here we have cash accounting concepts, and it's all to do with when revenue and expenses are recorded. So on a cash basis, revenue is recorded, for example, a sale, when the cash is received. That means that we are not recording things like credit sales in our accounting system because we have received no cash at that stage. On the flip side, for revenue in the accrual accounting system, we are recording it as soon as the work is done and we are owed the money. So when we send the invoice out, it means that we are accounting for things like accounts receivable. And an extension of that is we are also trying to make sure that we have the exact right amount of sales that we've actually earned within a financial year in our accounting system. So if by accident maybe we recorded some of next year's sales in our accounting system, we need to fix that. And the same sort of thing goes for expenses. So for cash, it's when we pay the money, when the money leaves our bank account. And under the accrual system, it's when we're invoiced so that we owe the money to our supplier. Alright, there's a couple of examples here. If we are adopting accrual accounting, so that right-hand side, then these are the sort of considerations straight from the book that you would have to make at balance day, which is 30th of June. So the top example is just that insurance was paid and recorded in May, but it covers 12 months. So as you know, the end of the financial year is June, so May and June, there's a couple months there where the insurance relates to the current financial year. But most of it, 10 months of it, is actually for the following financial year. If we were accounting on a cash basis, then we would just put all 12 months when we paid for it in May. But on an accrual basis, we should be trying to do a split. For B here, it's a similar situation, except it's for wages. Now we're going to have an example like that later on, so I won't spend any more time on it now. Let's head back to that topic list. So we've covered off cash versus accrual accounting, and hopefully you are comfortable with those concepts at this point. Because if you are, then we are ready to head on to balance day adjustments. And I think you've probably already got a good idea of the purpose, but we'll go in and have a look anyway. So the purpose is to adjust our revenue and expense accounts to ensure that figures reported are accurate for the current financial year. We don't want any of last year's figures in this year's profit and loss. And we don't want any of next year's figures in this year's profit and loss. We're just trying to adhere to our matching principle. Now, if you're not sure what the matching principle is, then you'll want to head back to your first accounting unit and chapter 1, where it goes through a lot of the accounting principles that we adhere to. Okay, so there's our purpose. We now know the general idea of why we are doing balance day adjustments. There's a couple of categories that we're going to go through in detail. So they're called reversing and non-reversing balance day adjustments. Alright, another side-by-side comparison. On the left we have reversing, and on the right we have non-reversing. Now they're called balance day adjustments because our balance day is 30th of June. And on both sides here, for both categories, we are going to be recording the balance day adjustment on the 30th of June. Alright, now on the left, this is the first major difference. The next day, on 1 July, we're going to undo what we did on the 30th of June. So that's called a reversing balance day adjustment, when it's really only having an effect on the day that we prepare our balance sheet and our profit and loss, the balance day. After that, we undo it and we go back to business as normal. On the right hand side, non-reversing balance day adjustments, these do not reverse. So any change that you make on the 30th of June, any change you make is going to be permanent and stay in the accounts. Alright. So always just think about the general ledger effect that's happening. This one's temporary on the left, the reversing, and then on the right, the non-reversing. They are permanent general ledger changes. head back to that topic list. There are 4 types of reversing balance day adjustments, as you can see in this little preview over here. But let's go take a quick look at all of them before we jump into each one in detail. So here they are: accrued expenses, prepaid expenses, accrued income, and income received in advance. Right, so accrued expenses. These are expenses that we've incurred, so we've been billed or some other event has caused us to incur them, but we haven't paid them yet. We haven't recorded them in our system. And obviously that's not ideal. The point of a balance sheet and a profit and loss is to present an accurate picture on the 30th of June of the organization. So if we have incurred these, but we haven't recorded them in our system, then we are missing some vital information to present that accurate picture. So the idea of recording these is to create a liability. And if you think about why that is, hopefully it makes sense. A liability is something that we owe. And if these expenses have been incurred but we haven't paid them, then they are definitely something that we owe. So prepaid expenses is the next one. Now these are you have paid for a period of an expense that relates to a future financial year. And this is that insurance example that I covered off at the start of this session. Okay, so with a prepaid expense, we take the amount that relates to next financial year, and we take it out of whatever expense account it's in, and we put it into an asset. So that's why it says these are an asset. And maybe that's a little harder to understand, but if you go back to your definitions of what an asset is something that we own, something that has value to our business, and it will present not just current value, but future economic value. So if we've prepaid an expense, that's going to give us a future benefit when we use it up. So that's the reason these are an asset. Accrued income. So this is income that we've earned. We've done the work for it, but we haven't invoiced it yet. So if we haven't invoiced it and we haven't been paid it, of course we haven't been paid it if we haven't invoiced it, it's not in our records at all. We've done the work, but we don't have any general ledger effect yet. Now that would mean that our profit isn't quite what it should be. If we've done the work, then technically we are legally owed that payment. So the accrued income adjustment is about adjusting our profit to increase it, and then representing that we are going to get a future cash flow from that via the creation of an asset. So that's why it's an asset. We're going to get a future cash flow from the accrual of this income. Income received in advance. So this one here is when someone has paid us too much. Maybe we haven't done the work yet. Or maybe we've done part of it, but not all of it, and they've just paid us in advance. Because we haven't done the legal requirement of earning that income yet, it would be inaccurate to have that income on our profit and loss statement. So we take it out and we put it in something called a liability. Because if we don't legally own the money they've given us, well then technically we owe it back to them at this point. We may not necessarily pay it back to them, because we know that we will do the work eventually, but legally right now we owe the money back. So that's why we're going to create a liability for any income received in advance. Right, so that's an overview of the balance day adjustments, why we do them and what types there are. I think the next thing we should do is go through each one at a time and cover off an example of how it will work. So accrued expenses is first. Now, the example that I have here is that we have a company called XYZ Pty Ltd, and payday for XYZ Pty Ltd is weekly on a Friday. Now if you look at a calendar for the year ended 30th of June 2020, that 30th of June there is a Tuesday. That's why I've got a Tuesday here. And given that payday is on a Friday, by the end of Tuesday, staff have worked on Monday all day, and they've worked on Tuesday, the 30th, all day. So they've worked for 2 days, and they haven't yet been paid for that 2 days' work. So we owe them that money. However, as you know, when you're recording payroll, it will happen on the payday or soon after. And that's when the general ledger effect will come in. So at the moment, we owe the staff 2 days of pay, and we haven't put it in our system. Now the question makes things pretty simple for us. It says that it's been calculated that the gross wages that we owe for those 2 days is $500. Okay, so that's the cause. That's the reason we are preparing a balance day adjustment. And this is an example where we haven't recorded anything in the system, but we should have. All right, so balance day adjustment. Wages would not have been recorded for Monday or Tuesday, and it's going to be inaccurate unless we fix that. So here's how we're going to fix it. We're going to increase our wages expense account. Now wages are an expense type, so expenses have a debit nature. So if I debit them, they will go up. So I'm increasing my wages expense. Accrued wages. We said earlier those are a liability. So accrued wages have a credit nature as a liability, and we are crediting them. So they are also going up. We owe this $500, and because we legally owe it, we can also incur the expense. We're going to reduce our profit by that $500 that we owe. All right, so that one's recording the expense incurred, and that one's recording the liability owed. Okay, so as with all of these reversing balance day adjustments, we also have to think about the reversal. Now the trick with the reversal is you are just doing the exact opposite of what you did on the 30th of June. So in an exam environment, it's actually not that hard. You've done the hard work on the previous page where you've recorded the balance day adjustment. That's when you need to use your brain and use reasoning as to what should happen here. We should be recording a liability that we owe, and the other side as a debit is going to increase wages. Over here, you can just flip them around. So the liability, we did credit it originally, we're now debiting it. And then wages, which we debited originally, we're now crediting. So we're undoing our changes completely. Now the reason for that, if reasoning will help you, is the top line here is we're trying to close out that liability to zero. We no longer will owe this money because we're going to remove the wages expense from our system too. It's going to be recorded on the Friday when we pay them. So if we left wages expense increased by $500, as we did on the balance day, it would double up when we pay them on the Friday, because we're going to pay them for the full 5 days work. So that's why this is a reversing entry. It really is only needed for the 1 day that we prepare the reports. After that, we undo it and we let normal business operations record things as they will do. Okay, so that's your typical accrued, get these crosses back on, your typical accrued expenses example. Let's head on to prepaid expenses next. So again, we have XYZ Pty Ltd. This time they've paid for 12 months insurance, and they did it on the 1st of June 2020. So how many months relate to that 2020 financial year? Hopefully you're answering 1, because 1st of June through to the 30th of June is 1 month worth. Now, the full 12 months, they cost us $13,000. Now, when that came through the accounting system, so it might have been a bank feed, and they might have put it to insurance expense at that point, on this date, the following journal was recorded in the accounting system. So notice they didn't think about it being prepaid. They just recorded insurance expense as a debit and bank as a credit for the full amount. And that's the typical approach to these sort of expenses. The prepayment thinking and the accrual thinking tends to all happen on balance day on the 30th of June. Although it's not 100% done that way. As I'll show you later on, there's something called a standing journal. But for now, this is the typical way of doing it. We make the mistake whenever the expense was incurred. So this time, 1st of June 2020, and then on the 30th, we fix it. Of course, our bank's going down for the full amount that we paid there. Alright, so currently, our insurance expense has 12 months of insurance sitting in it, but it should not have 12 months in it. Some of that relates to next year. So after recording the initial transaction, expense account has 12 months in it for the year ended 30 June 2020. How many months should be in the expense account? So you go back to the question, you'd say, well, if we incurred it on the 1st of June for 12 months, only 1 month of that takes us to the 30th of June. So really, our expense for insurance, the only part that is relevant to the current financial year, is 1 month worth. So how are we going to fix it? There's our cause. How are we going to fix? Alright, so I've kept the question information up the top in case you need to refer to it, but here's the maths for how we're going to work it out. The prepaid component is 11 months. The 1 month that relates to this year is in the middle line here, and then we've got the full months up the top. So you start by just listing out your full 12 months and the dollar value of that. To work out 1 month, you take whatever the total is, so 13,000, and you divide by the number of months that it related to, so it was 12 months. So that brings us back to 1 month. $1,083.33 per month is how much we pay for insurance. That means that 11 months is going to be calculated as being the full amount, so 13,000 divided by 12 brings us back to 1 month, and then we take that 1 month's insurance and we times by 11 to get up to 11 months insurance. And just remember that this number here is what should be in our expense account at the moment. It's not. We still have 13,000 in there, but we should have 1,083.33, just that 1 month of June that relates to the current financial year. And that prepaid amount, well, that's something that we're going to get as a future benefit. It won't relate to this year. It's going to relate to next year. And when someone says to you, future benefit, you should immediately be thinking of an asset, because it's not a current benefit, it's something we're going to get in the future. So this is the asset component, and this is the expense component. So let's fix the problem. The balance day adjustment here is we're going to take our insurance expense and decrease it by $11,916.67. We're going to create a new account. This was empty before. It's called Prepaid Expense. And we're going to increase that because it's an asset, and assets have a debit nature, by $11,916.67. So there we are with a balancing journal. Now each of these lines here, here's the explanation. So we're going to create that new asset for the prepaid portion of the expense, the 11 months, and then we balance the transaction by reducing our insurance expense by the same amount. It can really help with these to picture what's happening in the ledger. So note that this is a journal entry. You should be comfortable with the difference at the moment between journals, which is step 1 of the accounting process, and ledgers, which is where we post each of these lines. So I'll give you a little extract of a general ledger to look at here. What we've got is on the 1st of June 2020, we paid for our insurance expense. And when we paid for that, you may remember that the original recording of that increased insurance expense by the full amount. We made the mistake on the 1st of June. We increased it by 13,000, the full 12 months. So of course we're left with a debit balance of 13,000. Now we've fixed the problem, because on the 30th of June 2020, we have now recorded prepaid insurance. And by recording that prepaid insurance up here, we've credited the insurance expense account. So down here, you'll see that credit, $11,916.67. And then take a close look at this final balance here. Now I do have another view of this, which I think may, if you're a bit confused, it may help a bit. So let's just get everything up on the same screen. So here's the original cause. On the 1st of June 2020, here we are, incurring our full insurance expense, 12 months worth, $13,000. The balance day adjustment, we are now decreasing that insurance account, and we're creating our asset. So let's trace the insurance lines, how you would post those to the ledger. Let's get some visuals on how you would trace that. So the first one here, we have insurance, a debit, 13,000. And you can see that that debit of 13,000, it's come down to become this top line in the insurance expense general ledger. So yes, if I go over to the dollar value here, we have a debit for 13,000. For the balance day adjustment, that's become this insurance. Remember, we're only talking about insurance expense at the moment. We have a credit for $11,916.67, and that's going up here to become the second line of this general ledger. And there's the credit for $916.67. So the key is, after we've done these two changes, look how much is left in the balance of our general ledger. We have $1,083.33. So always a good idea when you have finished your balance day adjustment to post to the ledger. Even if the exam doesn't require it, post to the ledger, even just a little extract like this, calculate how much is in your insurance expense general ledger. And if it's not what you expected, then you might have made a mistake. You might have flipped the numbers around or something like that. And that's why it was really important at the start to identify how much should be in there. Only 1 month worth. And if you can confirm that at the end of the process you've got 1 month in there, then you've done it right. So the 108,333 is what we calculated on a previous slide for 1 month's insurance to be. So if you've forgotten where we got that 108.3, just go back in the video a bit where we calculated it. So we've corrected it, we've fixed the problem. We have the correct insurance expense in our profit and loss statement for the 2020 financial year. But of course, as a reversing a balance day adjustment, after we have caused the problem, then fixed it with a balance day adjustment, we also need to do a reversal. So this is the only new bit. We've covered the rest. So the reversal is the exact opposite of the balance day adjustment. We've taken the debit of prepaid expense and we've switched it to a credit, and this credit of insurance became a debit of insurance. So what does the general ledger look like now? Well, the lines that we've looked at already are this one and this one. And you might remember that on balance day, that was our goal, the 108,333. Now, depending on where you're at with your studies, you may or may not have covered the concept of closing entries. Closing entries, they happen again on 30th of June, and what they do is they close all of your revenue and expense accounts out to zero. This is after you've finished preparing your reports, so you'll close all of your revenue and expense accounts to zero to get ready for the next financial year. So that's why you're seeing a zero over here. All right. Now the prepaid expense line at the bottom here, where that's coming from is this reversal. So with this reversal, it's going to completely undo this 11,916.67 that we recorded. You can see that it's the exact opposite here. They will cancel each other out. And it brings our balance back up to 11,916.67. And that there is 11 months worth. And when we're in the next financial year, which, as you remember, hopefully, 1 July is the next financial year, we should have 11 months of insurance expense in that account. All right. So you can see now that there are 3 different effects for insurance expense. We have the top line, the second line, and the bottom line. And then this closing entry, you don't have to do that at the moment. If you're just learning balance day adjustments, don't worry about that until you cover closing entries, which will probably be the week after you do balance day adjustments. All right. So we are now up to accrued income. Let's go take a look at that. All right, now XYZ Pty Ltd, they really like causing problems for us. This time they've completed a job, the value of which was $3,000 for Barry, and they decided to complete it on the 29th of June 2020. But they haven't invoiced him yet. For whatever reason, they haven't got there. So they've decided to wait until next financial year to invoice him. So we've done the work, we've earned $3,000 of income. It's not yet in our accounts though. So our accounts aren't accurate at the moment. If we're expecting to get this $3,000 income, as we should if we've done the work, then we need to put it in the accounts. So I've just got this little note in the last sentence that says, if we had invoiced Barry, this income would already have been recorded. And if you go and look at your chapter where you covered credit sales, you'll see why. As soon as we send that invoice, we're going to record accounts receivable, debit to increase, and then we'll have sales on the credit side, increasing our revenue. In this case, though, we have not invoiced them, which means we don't have anything in our system at this point. Right, so there's the cause. Now, the balance day adjustment to fix this problem is again on the balance day, 30th of June, we are going to increase our sales by the amount that we earned. So I always start with that second line there. We're going to record the revenue that we earned. Now, because we're expecting to get this money in the future, it's very similar to accounts receivable. And accounts receivable is an asset. So that's why accrued income is also an asset. It's money we're expecting to receive in the future. So we're going to increase that asset to represent the future benefit we're going to get. All right, next day, as usual, there needs to be a reversal. Now, there's a problem in these slides. Hopefully you've been able to spot it. If not, you'll see it in a second. I'm about to fix it. There we go. Did you see what changed? Reversals always have to happen on the day after the balance day adjustment. They happen on the 1st of July. Otherwise, we've completely wasted our time. If we posted the balance day adjustment and then on the same day undid it, we might as well have just twiddled our thumbs. So the next day on the 1st of July, we will reverse it out. And the reason for that is because we need to take away this temporary income that we declared. It's going to be re-recorded. When we invoice them, it will get recorded then. So if we had it in our system and we'd forgotten to reverse it, then when we invoice them, we would have doubled up on that $3,000 of income. All right, we do need to close off our balance day account, the accrued income account, to 0 because we're no longer expecting to receive that money until we invoice them. All right, so I've got to go back to my topic list now. Where are we up to? We've just done accrued income. So the very last reversing balance day adjustment that we're looking at today is income received in advance. Okay, the scenario in this instance is on the 5th of June 2020, XYZ Pty Ltd notices that one of its customers has paid them for work that is not due to be completed until next financial year. So we've got a really good customer here. They've sent us $1,000 that they don't owe us yet. We haven't invoiced them. So the following journal was recorded when XYZ received the money. So this was the mistake. What we would have done is gone, okay, well, our customer's given us money. So without thinking, we go, okay, well, bank's going to go up. That's the cash that we received. And that's fine. That's actually correct. The bank did go up by 1,000. That's not the error here. The error is the second line. Sales also went up by 1,000. But by increasing our revenue, the sales account, by $1,000, we are saying that we have done the work and that we are owed the money. So that's a problem. We need to fix that issue. Bank, though, we won't change. It did go into our bank account, and that's a fact. So how are we going to fix this? The balance day adjustment will only affect the error. So the sales line, we're going to undo that. It was a credit for 1,000. We're going to debit it for 1,000. We're going to undo the erroneous recording of the $1,000 of sales. Now, of course, we need to balance the journal. So we've got a debit. We need an equal and opposite credit. And this is where the balance day adjustment account comes into effect, income in advance. Now, the reason we are using a liability here is because we are creating something that we owe to our customers. We have $1,000 in our bank account that we recorded on the previous slide that we illegally owe back to the customer until we've done the work. So this is a liability at this point. We owe them the money until we do the work. All right, now the next day, again, I've got my date problem. Let me fix that up. Here we are on the next day, 1 July 2020, and we're going to record the exact opposite scenario of what we did on the previous slide. And as always, with these reversals, you don't have to understand them if you don't want to. You can just do the exact opposite of your balance day adjustment, and that just takes off one bit of pressure for an exam or for whatever you're studying for. But the reason, if you're interested in the reason, is we close the liability, the amount that we owe, out to 0, and we're going to put the $1,000 back in sales. We actually are making an assumption that we will do the work and we will invoice them. So we're just going to leave that in there for that point. Now the reason we do that is probably the hardest one to understand is because they have paid us this $1,000. They're not going to pay us again. So as a part of our normal business operations, the sales won't get recorded again. By leaving it in sales, we're not going to double record because we won't get paid it again. So we'll leave it in there. Look, worst case scenario, if we didn't end up doing the work, then we would have to do an adjustment. We'd have to decrease our sales, and then we would have to send the $1,000 back to them by decreasing the bank account. All right, if you need further help on these reversing balance day adjustments, you can head to chapter 14 of the book. Chapter 15 of the book. All right, so final topic, non-reversing balance day adjustments. Now, you may remember, as we discussed earlier, these do not reverse on the 1st of July. So if we make a change, it's a permanent change. Let's look at depreciation. Now, you have an entire chapter in the text on depreciation. It's chapter 14. And you do have a week's content on it at TAFE if you are studying there. So I'll assume you know the basics for this video. We're just going to focus on the balance day adjustment side of it, and that is to note that it's non-reversing. It's a permanent change we're going to be putting in. And the reason it's non-reversing is, well, the point of depreciation is to adjust the value of our assets. Wouldn't make much sense to only do that for one day. We want these adjustments to stay permanent, so we always have an accurate picture of what our non-current assets are worth. And there's a little recap of the balance day adjustment. We're increasing the expense, and we're also creating this contra asset, which is going to reduce the value of our non-current assets in the balance sheet. Alright, so there's depreciation sorted. Let's take a look at inventory variance. So for this one, we're assuming that we're using something called the perpetual inventory system. And what that means is, every time there's a transaction involving inventory, so maybe we sold some stock or we bought some stock, our inventory account will be updated. And that's why it's called perpetual. They are perpetually updated. So in this example here, XYZ Pty Ltd, they use a perpetual inventory system, and they've done a stock take on the 30th of June, and they have noted that their stock value, in reality, when they counted them, is actually $300 less than what their system says. Now, theoretically, that shouldn't have happened. In the perpetual system, every time we buy and sell stock, our stock goes up or down. So it should be accurate. However, they went and counted it. So the difference must be unrecorded reasons. And one of those reasons could be theft. So maybe people have stolen $300 of stock over the year. And this is how you would record that. You would start by decreasing your inventory account. Inventory is an asset, which has a debit nature. So if we credit it, we're decreasing it. And then the balancing side is we're increasing an expense called theft expense. There are other reasons that the stock may have gone down, so shrinkage and spoilage and those sort of things. But you'll always have this credit to inventory, and then the explanatory side will be the debit side, and that will be increasing an expense account, generally speaking. All right, next thing to look at, provisions for leave. So I'm talking about annual leave, long service leave, personal leave, all those leave entitlements that your employees get. They're not going to be in the system as far as a general ledger goes. You might have a payroll system, such as MyOb does, where it keeps track of the number of hours your staff are owed, but that's not represented in your balance sheet as a liability. And when you think about it, it should be, because if you owe someone annual leave, then you have a debt. Even if they haven't cashed it and you don't know how they're going to take it, at some point you'll have to pay it. So a lot of organizations, they will have this policy where they will record their annual leave, their long service leave, and in some cases their personal leave as something called a provision, which is a type of liability. So the way to do this is you create your liability with a credit to the provision account. And in this case, we have $800 that we owe at the end of the year. And then we increase annual leave expense as a debit, as the other side. So we've incurred the expense by recognizing that we owe this $800. All right, very last topic for today, and that is standing journals. Clicked the wrong thing. Okay, standing journals. Let's look at those. So standing journals, they're variations on the typical approach to a prepaid expense balance day adjustment. Well, these actually work they do work for unearned revenue as well, but we're going to focus on the more common one, which is prepaid expense standing journal. So the prepayments, they're recorded at the date of purchase instead of the date of adjustment. So you might remember that when we were doing the prepaid expense balance day adjustment earlier, we made the mistake on the 1st of June. We actually let ourselves record the $13,000 of insurance, knowing that a lot of it did actually relate to the next year. And then on the balance day, the 30th of June, we fixed it. We transferred out the prepaid amount from the expense account. Now, the standing journal approach is pretty much the opposite. We're actually going to record everything to the prepaid account. So at 30 June, what we're going to do is instead we're going to record everything to the prepaid amount on the 1st of June, and then 30th of June we write off whatever we used to the relevant expense account. Now, it's one thing to verbally talk about it. It's going to be much better if we have a look at it on the screen. So, bringing back that exact same scenario from earlier. XYZ, they've paid for 12 months insurance on the 1st of June, and that the full 12 months cost them $13,000. The instruction this time has told us to record as a standing journal. So this is what it will look like. We're going to debit prepaid insurance for $13,000. In the first example, we put it straight to insurance expense. This time, we're putting it all to prepaid, all 12 months of it. Bank won't change. We definitely paid it out of the bank account. And then on the 30th, our balance day adjustment looks like this. We are going to increase our insurance expense account up to the level it should be, so that 1 month. Keeping in mind we haven't got anything in there at this point. We didn't record any insurance expense up here. So we're increasing insurance expense to the 1 month level. And where are we getting that from? Well, we're taking it from our prepaid insurance asset. So we're actually going to reduce that asset down to down by 108,333. So let's check out the general ledgers and the effects that would have happened. And this time we're going to trace the prepaid insurance lines. So here's the original prepaid insurance transaction. We've debited prepaid insurance for $13,000. The asset, the amount that we have prepaid, is the full 12 months. This insurance expense line, the debit of 108,333, ended up over here, where we end up with 1 month worth in our general ledger for insurance expense. This prepaid expense credit goes down here as the second line in our prepaid insurance. And what's happening there is we are taking the $13,000 that was prepaid, we're reducing it by the amount that was used up this financial year, 108,333, or 1 month's worth. And you'll see that what's left over in our general ledger is 11,916.67. All right, and just take note as well that that insurance expense account, that has the 1 month in it. So in the end of the day, it's these two final figures that matter. When you're dealing with a prepaid expense, if you end up having the 1 month, the expense component, as your final balance in the expense account, you've done it right. If you end up having the prepaid amount, the 11 months, over in the asset account, then you've done that right as well. So we're just always focusing on the final effect in this general ledger here. All right, now just remember that's a special scenario where they've asked you to do a standing journal. It's generally not done that way, and you can follow the instructions from earlier on in the presentation. All right, guys, that's balance day adjustments. Feel free to watch that, of course, as many times as you need. Contact your teacher if you need more assistance, and there are plenty of exercises to practice in the relevant chapter of your text.